Hi, I'm Professor Bei Dong from USF School of Accountancy. Today we're going to cover some topics related with current liabilities and contingencies. In this audio, we're going to discuss current liabilities. So, what is liabilities and what is current liabilities? FASB defines liabilities as probable future sacrifices of economic benefits arising from present obligations of a particular entity to transfer assets or provide services to other entities in the future as a result of past transactions or events. So we can see that liabilities are those present obligations which actually resulted from past transactions or events that already occurred and ask companies to sacrifice economic benefits, for example, transfer asset and or provide services to fulfill this obligation. So this is liabilities. And current liabilities are those obligations actually requires companies to use current asset or the creation of other current liabilities to pay for this current liabilities. In terms of presentation of current liabilities, all the current liabilities are reported at face value in the current liability sections of balance sheet. And we ignore the present value, which means that given the time horizon of this type of liabilities, we ignore the immaterial time value of the money. And this is the General Mills current liability section. We can see that in this section, they include something like accounts payable, current portion long-term debt, short-term notes payable, okay? And this section is listed in front of the long-term liabilities in the liability sections. Now, let's talk about some typical types of current liabilities. The first one, accounts payable. Accounts payable represent money owed to your suppliers, usually, for goods and or services which is purchased on account. For example, one day you purchase something from your supplier, you didn't pay cash. So on that transaction date, accounts payable is generated, liability increase. Second one, notes payable. Notes payable is a promise to pay on a specified due date and is caused by purchase or financing transactions. The difference between accounts payable and notes payable is that notes payable is a formal legal instrument document, while accounts payable is not. And usually notes payable will have some interest on it, while accounts payable is sort of the free loan provided by supplier to the purchaser. The third one is the current maturities of long-term debt. This is a portion of long-term liabilities that matures within the next fiscal year, 12-month period. Okay, for example, you have a 10-year mortgage, and this is a long-term liabilities. However, this year is the 10th year. Then on the balance sheet, we need to reclassify these long-term liabilities to the current liabilities section. The fourth one is dividends payable. Dividends payable are those dividends declared or announced by a company's board of directors to its shareholders but not paid yet. Usually, companies are not going to pay dividends in cash in the same day when they announce dividends. They usually announce first and then they're going to pay cash later. So dividends payable increase in the day when they announce this dividend payment. The fifth one is this unearned revenue. Unearned revenue is called revenue, but is not revenue, it is a liability. This represents advances or deposit received from your customers for goods and or services expected to be delivered in the future. Number 6 is sales tax payable. This is a tax charged by companies for the government when selling goods to the customers. So they collect it from the customers, and then later they're going to transfer these funds to the government. Number 7, which is the last one, income tax payable. This is a tax charged on the company's net income according to its corporate tax rate and will be paid to the government within 1 year. So this is a current liabilities also.